Here I'd like to talk about timing and how to use macrograph to increase your odds of timing a breakout or the onset of a trend. When you create a macrograph, there's a spreadsheet that comes with it. Inside that spreadsheet are some valuable stats that could help us time when a market is ripe to run or trend. I designed macrograph to give you both a visual and mathematical edge when timing trades. When I do my visual checks looking for markets that are ripe to run, I look for bell curves that show above average time at price and below average vertical ranges. These types of profiles often precede big moves. In this spreadsheet, let's focus on TAP, or time at price. The shaded days are sessions that we spent above average time at price, and I added another filter, and those very same days also had below average ranges for the day. So we're looking at two dimensions, vertical and horizontal. This chart illustrates all the data we saw in that previous spreadsheet. Where you see a T plus, those are the days that were shaded, the ones that had above average time at price but below average ranges. And you can see that those types of days preceded rather large moves, or when a market broke into trends. So I think it's important to understand the characteristics or the traits of the market that you're watching. That's why we have the spreadsheets. So always be aware and on the lookout for these short, wide bell curves because they precede trends, or even reversals, as you see in this last example. Basically, markets do two things. They move and they coil. So it's important to have a timing mechanism when implementing a trend type strategy. There are other timing mechanisms. We'll get into those in other video shorts. There's a mean reversion type strategy.